Hello, hello. Good morning, everybody. Welcome to the Flow Show. Morning, Kay. Morning, Stel.
Hello, hello.
Morning.
Good morning.
Good morning. How are we all doing?
Very well, thank you.
Yeah,
All good.
Good.
Good. Right. Well, absolutely nothing going on today, so we're going to call it a day. And
All right. See you next
tomorrow.
week.
See you all tomorrow.
Where do we go? We got some data today, though, don't we? Hold on.
Yeah, we get plenty of stuff today.
PMI ISM is tomorrow.
Yeah.
I thought it was today.
Tomorrow.
False
Yeah.
alert.
Yeah, manufacturing yesterday. Services tomorrow.
Yes.
Just quiet day. Just jobless claims day, I think. Jobless claims. Yeah, that's it.
And labor costs. Yes, secondary
Yeah,
stuff.
for rubbish. Old hat. The rearview mirror. But
How you
yeah,
doing, Ryan? You good? How are things?
Yeah, all good, mate. All good. Sun's out. That's all that matters. Even though it's freezing cold, sun's out. Makes everything more cheerier when the sun's out. As you well know, get 364 days a year where you are.
Mate, we're so lucky.
Yeah, we're not jealous. Anyway, let's get into it. China and Belarus are to further boost their strategic partnership. Xi apparently had a call yesterday with Belarus leader Lukashenko about the closeness of ties and being all pally and chatty. That's once again playing into this geopolitical mess that we've got going on regarding what's going on with US, Russia, China, Ukraine, Taiwan, all that sort of stuff. So that's part of that. China, apparently, according to sources, may aim for a higher 2023 GDP growth target than the current 4.5% to 5.5% they expected previously in November. They could set a growth target between 5 and 5.5%, and it might even be as high as 6%. They will be looking apparently to stick to their long-standing inflation target of around 3%, and that was Chinese sources there of people who know what's going on with policy over there. So a lot of the market looks at the growth forecast from China, because if China say they want growth at such a percent, we all know how they can, how should we say it, massage the data. Then they will try and get it to their targets, because if they don't, then they're letting the people down in their eyes, and there can be no failures as far as China is concerned. So we saw decent numbers from the PMIs yesterday. Maybe we're going to start to see Chinese data improving, which then becomes a risk trade for the rest of the world. But it's not all going swimmingly, particularly for Australia, because apparently Chinese and Australian trade officials have hit a snag in their first meetings with regarding their trade efforts of getting things back on track. They've been talking about wine, lobsters and logs, according to the SCMP, and they're finding some sticky points around tariffs and various investments that the Chinese wanted to do in certain sectors that Australia blocked. So snags there in those trade talks that we've been speaking about for couple of months now, really. More floods of Bank of Japan members talking. It seems every day we get a few now, and they are all coming out with the same lines. Yesterday it was Takata saying that must maintain current massive monetary easing. And now is the time to scrutinize whether Japan's economy and prices can generate a positive cycle. And Kay, I think I've nailed down our sources piece. For those of you who are in the chat room, you'd have seen we were talking this morning. There was a sources piece by Bloomberg saying that the Bank of Japan apparently going to sit and wait to see the effects of their December change on the YCC and other stuff before maybe thinking about what they do with policy next. And it was Takata overnight who said, we will need some time to gauge the impact of December steps on market function, and don't see the need now to take additional steps to improve the market function. So I think Bloomberg might have been doing a bit of a fiddle on that one? Do you think, Kay? You rehash and calling it sources?
That was clearly made up by Bloomberg, like people familiar with the matter, making it sound like they have sources, but that was absolute bullshit. They were just reporting what was said earlier. It was enough speakers. The one thing I would say about those speakers is that they seem to align. So there's a couple of things probably. Ifeeda against all odds would want to break the gridlock in a big fashion. It's not what he said either, but assuming that data tell them that they really have to do something, he might encounter some pushback from other members so far. So, but the good thing is that they are all speaking one line, so that makes it a little easier for us to read. That is somewhere. It doesn't give us the direction, but it's kind of a positive. It would be a lot messier if we had completely opposite opinions and people voicing different approaches for the monetary policy and how they see things. But it seems that they are pretty much aligned.
Yeah, very much so. And it seems like a bit of a media offensive at the moment. Some of these members we don't hear for 6 months, but they all seem to be coming out round about now.
We are at the eve of big changes, right? Corona's last meeting, Ueda taking over, the biggest wage negotiations in decades. We are ahead at the eve of a big events in Japan. There's no denying. So. I guess that they've all been either tasked or they want to voice their opinions before the possible storm or the wet sprocket.
Yeah, and the next Bank of Japan meeting is the 10th of March. So that is just over 8 days away, or around about 8 days away. Expectations are for an unchanged rate probability is 90.1% that rates are left unchanged, 9.9% that they get hiked by 10 basis points. That's always in the case in this probability pricing. It's never a straight 100% on unchanged there. Do these guys go into a blackout period at all? I can't remember.
Beat me, I don't know. No,
well, I wish they would.
unless it's just 1 week, because they're still talking and we're March, and it's at least not the 10-day period. But I really don't know. I don't know the answer to that.
No worries. Let's come over to another credible central bank, the ECB, and Nagel also has been flapping her gums quite a lot recently. Won't speculate on when a rate peak may be reached. And that APP roll-offs could rise to 20 billion a month from July. Some things you were talking about this week that one act the ECB could do as a form of tightening is to up the rolling off of QE. ECB's Visco says the pace of any further hikes beyond March to be decided on the basis of incoming data. The impact on inflation outlook, on the basis of incoming data and the impact on the inflation outlook. There is no question that policy tightening must continue. The risks of ECB under or over tightening are the same size. Even the German finance minister he's sold on what the ECB are doing, saying we must expect further tightening of ECB monetary policy and thus rising rates. And Her Majesty Queen Suntan was out as well this morning, saying the case for a 50 pip rate hike this month is still on the table. Inflation is still too high, and we have to use all tools at our disposal to bring inflation down.
Did she? Sorry, Rain. Did she say it's still on the table? 50.
Still on the table.
Well, it's fully priced, isn't it? It's almost a given now, isn't it?
Yeah.
Or not? Am I wrong?
We're actually pricing 71% for 50 hike. in the probabilities. But the other side, we're pricing a 75 hike at 28.8%.
Ah, okay.
So
Gotcha.
yeah, I think we know 50's nailed on. She's been clear about it enough. They've all been clear about it enough.
Yeah.
What is going to be the market mover for the ECB meeting, which is on the 16th of March, is whether we're going to get any more 50s or whether they're going to slow. So it's not going to be the hike size this month unless it's a surprise outside of the 50. It's going to be about what the indications are for the months after this one. And I'd have to say on balance, I would suggest it may be looking like another 50 after that, because I see no need why they would need to calm down to 25s, especially considering what the inflation numbers have been doing. And that's evident today as well in the Eurozone numbers that we got. CPI coming in higher than expected at 8.5% versus 8.2 expected. Prior was 8.6. But look at the core, 5.6%, beating expectations and last month. So there is no need for the ECB to really get into talking about pausing or slowing or anything like that. So really it is, as I say, going to be about what they do moving forward at this next meeting more than what they do at this meeting. And QE increases and the roll-offs probably on the table to be signalled for later in the year. So what do you guys make of it from this Eurozone stuff? 1 minute inflation's dropping and then the handbrake goes on.
Yeah, this is surprising, the core inflation, surprising that it's going higher, and it should be worrying Lagarde. I mean, we've been talking about inflation in the Eurozone compared to, say, the US, and we've been saying that's going to be a lot stickier because of the energy dependence, and I think we're seeing that. Obviously, 1 point does not make a trend, but if it's gone higher from the last print, is this a blip? Are we going to keep going lower or not? It's definitely going to be stickier than the US. That's for sure. So I think this could be a reason to maybe suggest that there's going to be a policy divergence between the ECB and the Fed going forward. I mean, there is already, right? The Fed is doing 25s, the ECB is late on the party and they're doing 50s. But, I think there's a risk now that the ECB is going to do more than expected compared to the Fed. So it's worrying. I mean, I have to say this blip higher is worrying. Has to be.
It has to be said that the core always lags the headline. The headline is more open to when you get oil price shocks and things like that and big price moves. But it's the core that can lag, and that's the one they really will have a problem with. Headline inflation can go down to 2%, but that will be irrelevant if core is still up at 5-6%. So there is a lag with that. So it could. I mean, we saw similar with the US CPI. US CPI was coming down, and then we saw the core going up for a couple of months before it started to turn. And we still don't know if the core is really heading lower because of the PCE that we got last week. So you have to watch his core, and you'll see central bankers switching between talking about the headline and talking about the core, because that's the one they really got their eye on. And for now, you can see at the two charts there, that's the core still rising, even while the headline there is coming down. So as I say, this could drop all the way back down to 2%. It won't matter if that core is still up there at 5-6%. But it will follow the headline number at some point eventually. It just depends how long the ECB are prepared to let that happen before they pause acting or have to do a bit more. Lots to be seen. Kay, what are your thoughts on it? Is this just a blip in inflation, or
for the time being we have to stick with the higher for longer, right? And that's really the scenario that we need to follow now. And again, I'm going to repeat, they're all data dependent. So one of the data is the CPI, of course, and then we'll have to look at what's happening in the rest. What was worth noting is that on the last prints in CPIs in Europe, the euro in itself is not really benefiting from it. So there's other stuff going around. I think geopolitics is one thing, but yeah, also just purely price action. Perhaps the market is coming to grips with the fact that higher inflation doesn't really mean a higher currency all the time, because it can be for the wrong reasons, right? Yeah, for the time being, I think yeah, ECB will be forced to go. I'd say 75. People are trying to price 75, but again, there's a difference between when we say the market is there, and then you put it in numbers like the percentages, and really saying if you go and ask the big money managers, what do you expect that the ECB is going to do? Their flows may be saying, yeah, there's a possibility of 75 because they have to hedge stuff, but really they will probably say it's 50. And to me now, it's likely to be 50 and 50 now, the next meetings. I doubt they will go to 75 because we have heard lately Villeroy, Visco coming out trying to manage the expectations a bit against the Uber hawks in Germany, Austria, and more Eastern Europe. So yeah, I guess it's 50 and 50. But we looking at the data, we can't do anything else than saying like it's going to be higher for longer. And yeah, then we'll see how it goes. And I'm still not ruling out Stel's scenario that all of a sudden we are going to fall off a cliff starting Q2 or so in the CPI. We will see how mainly energy evolves. Food prices are going to probably remain sticky because if you look at the empty shelves, it's hard to see food prices coming off, right? And we are facing, as everywhere, we know in the UK, but it's probably everywhere in Europe, mainland as well, is that all the services are ramping their prices higher come end of March, April. So it's probably going to be the same in countries like France, Germany, or wherever you are. I know Stelios already said that they did not see those kind of hikes, but yeah, elsewhere, I reckon it's going to be higher.
Yeah, no, I agree with that. Right, well, let's move on then. We'll look at, well, let's go to Kashkari first, and then we'll look at the data. He was out saying inflation is very high and the Fed's job is bringing it down to target. He says he's open-minded on a 25 or 50 pip hike at the next meeting. He is a voter. But he says what we signal in March on the dot plot is much more important. So again, playing that game of where rates are going to go in the future, not what necessarily they do at that meeting, although he's putting two numbers on the table. He leans toward continuing to push up his policy path versus his December view, i.e. his dots likely to go higher at the next meeting. It is concerning that rate hikes so far haven't brought down services inflation. Over tightening policy is definitely a risk, but the risk of underdoing it is much bigger. So again, we're playing this dots game at the FOMC. Currently the top end's, I think, around 5.5%. Everyone largely aligned around 5.0, 5.25. How high this dot plot goes is going to be probably the basis for whether yields move significantly more higher and the dollar moves significantly more higher. If it's just a couple of outliers like your Bullards and your Kashkaris moving their dots up and the most of them stay around where they were before, that's not going to be as hawkish as if there are 5, 6, 7 people moving their dots much higher. That would be much more significant. But we've plenty of water to go under the bridge till the 22nd of March and the FOMC. So we'll be talking about the dots in more detail more towards that point. For now,
Brian,
yeah.
Is power long before the blackout? Because I haven't looked at the schedules, but is power long before we get the blackouts?
Yeah, 7th and 8th of March, I think.
Okay,
or
great.
7th or 8th.
All right.
He's given his semi-annual monetary policy, the old Humphrey Hawkins.
Yeah. Oh, okay, that's good, because I mean we hear a lot about all the others, but I guess he's going to be the biggest market mover. By now we know what Kashkari, Waller, Bullard, whatever I have to say. So
yeah,
I think for traders, it may be more interesting to know what he has to say.
Yeah, though given his record, when he's had plenty of opportunity to say something, he hasn't.
He walks the fine line, mate. He's clever.
Yeah,
he is clever.
And at these events, as I say, there'll be two. There'll be largely a repeat of each other because he speaks before both houses, the Financial Services Committee and the Senate Banking Committee. And he'll start off by largely repeating the last FOMC statement and all their outlooks, and then he'll take questions, and that's where we may get some additional tidbits to trade off of. But that's been confirmed for the 8th of March, and I think the other one's on the 7th of March. They're usually a day apart. Right, so a quick look at the data yesterday, because for me, quite a strange reaction. Or not, depending on your viewpoint. Let's get into it there. Oh, where are we going? So just quickly, the NBA was out, and another soft number there. Applications down 5.7%, following down 13.3% prior. So this one going in complete reverse to what we saw at the beginning of the year. As you can see, probably the damage is coming from that mortgage rate, the effective mortgage rate, 6.71%, up nearly 10 pips on last week. And that itself was up around 30 pips on the week before. So the market, again, getting more hawkish, reading more hikes to come. That's being reflected in the mortgage market, maybe putting some pressure on housing there. So coming to the ISM. And the headline number further into contraction, which you might have thought might be still negative given what we've seen in some of the other data. But it was this number that did for yields, sent them higher, sent the dollar up for a while, coming in at 51.3. So a big jump from the prior 44.5, moving into expansion. Prices paid is looked at as the inflationary component of these numbers here. Market didn't even care that employment went into contraction. So it was a bit strange. I wouldn't have thought the dollar and yields would have jumped as much as they did on that, but we got the test of 4% on that. What do you make of it, lads? I'm not sure I've seen dollar and yields move so much on one minor component, or well, I won't say minor, one component of the ISM rather than the headline.
Well, we had the move both ways, right? We had dollar going up, then getting a bit of a slap, and then going up again because the yields started to push higher. Now, as to why the yields started to push really higher, prices.
Is this anything more than just noise? I think it's just noise.
I'd say so too. And but we have to say that the dollar regains strength relatively easily. Yeah, and of course it's still all yields and everything, but it comes back relatively easily. It's still market is still just looking at what's happening in the US yields. I really have to say that this one, I don't really know why we are pulling up like we do, and it's not just in the 10-year yield above 4%. It's on the short end as well, right? 2 years is at new highs. I'm just looking, just scrolling over the yields, and they're all up and up and up. So 5-year, yeah, everything is up.
Yeah, I think which we'll talk about in a minute. You know, that's the theme we're we're playing at the moment. I mean, Fed swaps priced in a peak policy rate of 5.49% for September this year. That was after the ISM. The last count was back, I think, on the 15th of February, where they were pricing July at 5.45. So a little bit of a lift up there. We've obviously heard from some banks scaling up their forecast for the ceiling for Fed rates, but it's spreading into it's really a yield story across the board, and I'd say it's almost making it a zero-sum game for FX, because we had some people in our chat room saying, US yields are jumping. Why isn't the dollar following? Well, because the rest of the yields are going up. European yields are going up. UK yields are going up. So if each currency follows its own yield, it becomes a bit of a zero-sum game. But then you have to look at the weights of different central banks, because obviously what is seen by the Fed, one of the biggest, those moves are going to outweigh what the Bank of England do, even if they're going in the same direction, purely by size. So yeah, it becomes one of those things, because UK yields have been moving up, but euro sterling has been going up, i.e. the pound getting sold. We've seen cable lower, and we're getting this divergence play going on, because as far as we know, the Bank of England are looking to scale down hikes and maybe even go into pausing. This is coming while the ECB are about to hike 50 and may hike another 50. This comes while the Fed are potentially going to go higher for rates. So there's all different currents flowing, or moving at the same time, and it's becoming a bit difficult for some traders to understand what's moving what at one time. Sometimes it doesn't make sense. US yields ramping higher, but dollar yen's coming off. It does. Some things don't compute, but you have to look at what one's blowing, or which wind's blowing at the moment. This morning, it looked like the dollar was running higher. Dollar yen was getting back up to those highs. Just bringing it on a shorter term there, back up towards those highs, and then it came all the way off. And why did it come off? Because if you look at all the yen pairs were coming off as well. We'd seen moves lower down in the yen pair. So this morning there was a bit of yen flow. Not sure why. Might have been Mr. 8 AM man. Don't know. But that's what was happening. And, yields have been doing the same thing. So at the moment, there's a lot going on between what yields are doing and what the currencies are doing. And there's no straight lines to say that yield's going up, therefore that currency's going up. It really is about the way. I hope I'm explaining this clearly. If not, jump in, guys, and help me out. How do you view it?
Well, you're on your own there, mate.
I mean, euro dollar, it's coming down, but it's not collapsing. We're not getting down to those 105s like we were doing when, the dollar was really looking strong. This is just sort of mooching about, what is this, 70, 80 pip range that we've got already. It's not a lot. How do you pick the bones out of it? If you want to trade euro dollar, what are you looking at? Are you looking at purely levels, or are you looking at yields? Are you looking at US yields or European yields?
Both. I'm looking at both, as I've been showing here already as well, and I'll show the differentials. It's relatively explainable there, but then also I had some levels up in the high 106s like other people had as well. And it just kept the dollar is coming back, because the dollar market is the biggest market, and when the dollar moves, even if the rest moves in together with the dollar yields, you're always going to have some sort of the dollar taking the upper hand, because it's just the biggest market. It's size of market, as we've already been saying. Like for instance, with sterling. And we've no later than yesterday. You were talking about it. We were talking about it. The speed of the market. If the dollar goes up, usually some currencies will be accelerated euro dollars, and because of the size of the market. If you want to sell, I don't know, if you're one of the big customers also, and you want to sell, let's say, 500 million euro dollar, you're going probably to move it 3 pips. If you want to sell 500 cable, you're probably going to move it 10 or 15 pips, right? So.
Yeah,
and the thing where it's really very visible is the Scandies, for instance, because as soon as the dollar stopped coming off versus the rest, Scandies, Noki weakened, and Sweden weakened quite rapidly. If you look at the dollar Noki, is back to its highs, where the euro dollar is not at its lows, and those are those kind of effects that you see about liquidity in the market, which is sometimes something that we can get a little edge from, because sometimes it's just like if the dollar's wanted and nothing else is going on, assuming nothing else is going on, but if the US yields go higher and if you only look at that and the dollar is wanted, you will often see dollar yen going faster than the euro. Then the euro dollar going down, or the opposite. If yields come off, dollar yen will likely come off faster. If you look at it yesterday, or the day before, when we had a move back down in the US yields, dollar yen lost over 100 pips, where the euro dollar was moving 30 or 40, right?
Yeah.
So a lot has to do with liquidity in different currency pairs, but. Yeah, and sometimes, you sit in front of your screen and you wonder why something is happening. There is no other explanation than some flows, and we don't know about the flows. We are, at best of times, I'm not saying in the equity markets, but in the FX markets, the retail market is at best of times, I don't know, 5, 7, 10% when it's really going, when we really do a lot. But at best of times, we are 5 or 10% of the market. There's 90% of the market going on that we don't see, and we have to accept it, and we have to sometimes use it because it brings us to the levels of interest, and sometimes we just have to sit there and watch what's going on and let the market tell us what is going on.
Yeah, no, exactly, and that's why a lot of times we use the text, because if we can't know what's happening, we have to rely on what the price action wants to do. Yields jumped into 4% and pushed up, yet dollar yen couldn't break these highs. Is that significant? Time will tell. We're getting up to it again, while US yields are picking up again. And as I mentioned before, sometimes the FX side of the trade, when you're talking about yield correlations, runs into its own fundamental or technical or flow trouble. It doesn't always mean it's a 1-to-1 ratio, that just because yields make new highs, the dollar's going to follow in exactly the same footsteps. Sometimes there will be points where it pulls up because some in the market have got something to do at 137 and they're bigger than the buyers at the moment. And unless the buyers chew through what's on the offer, dollar yen isn't going to go higher. Even if US yields go to 4.2%, it might not go higher. It all depends how much people are going to do at that level and how strong the buyers are to push it through. So you get these little divergences now and again, but they create the trading levels. At the moment, we've got the potential for a short-term double top. If this move we're seeing now gets up there and fails again, then that's going to be 3 knocks on the door and a failure. Do we get another move back down to the lows, 135.20s? If that happens, we're setting up a potential range, much like we got down here. This range I've been looking at previously, quite wide. And in between that, we got ranges going on, 127s, 131s. So, trading wise, don't always think something is going to be going 500 pips up or 500 pips down. Nothing ever goes in a straight line. So if you didn't buy any of this rally here and you want to be long, you look for the dips and you pick your areas where you want to look for the dips. If you're not in a long here and you want to be long and you didn't get the dip, you look for the breaks. You know where your risk is defined. If we break above this 136, 80, 90, likely we're going to have a test of 137 and a break up there. So if you weren't long in this dip, that's where you look. You look to try a break trade, either on a confirmation or the price moving through. Conversely, if you want to be short, this is your level you lean on. This is the level you're wrong. If we get back above here, we're likely going through 137. So if you want to be short into this area, fine, but you know where you're wrong. And if the price comes down, you know where you want to be looking at maybe taking profit, because here is potentially some support. So it doesn't matter what we think, where the market price might be going. You just trade the levels at times, and that's really that's the crux of trading. You know, you've got numbers on the screen, use them. What do you make of it, Stel? This yield move, you've been saying yields are going up to back to those highs. Is this the break? It's looking like it's holding 4% for now.
Well, I always thought the level really is 433. That's where we're going to test. But we have broken. Remember, there's a trend line. You haven't got it drawn there, but there was a trend line which was passing through 6367 or something like that. And we broke that in early February, 9th of February, 10th of February. And when that happened, I think that was the day before the CPI or before a big number. And we said, yes, if it was any other day, we would have said, yes, this is a breakout, but we wait for the data. The data came in not weak. So we said, yes, it's a breakout. And I've been banging on. Sorry, I'm going to let my dogs in. Come on. Okay. Sorry about that. I've been banging about yields.
Hey, we're here already still.
I've been banging on about the yields grinding higher towards 433, and I still think this is the case, because if you think about it, yes, there are some data which are coming in mixed, of course, but the main ones, which is inflation, is still high. And I've been expecting inflation to drop at the end of this quarter. And it's not doing it yet. Yes, it's coming down in the US, but it's not coming down as fast as I thought. So this is a little bit worrying. I still think inflation is going to drop on a year-on-year basis. Will it go down to 2%? I think unlikely, but I think it's going to keep dropping. But for now, for the immediate future, for the next few weeks, let's say, I think we grind higher in yields because the macro outlook is unchanged. We have high inflation. There is no alternative for the Fed but to say higher for longer. So my view remains the same. I think we grind towards 433. What happens there is a different story. And that means that stocks grind lower as we go there. It remains my view. I know I keep repeating myself. You can probably record that and play it tomorrow.
We do record it. Well, I've got an important question for you. As you just mentioned, you've just let your dogs in. Who let the dogs out?
Who let the dogs? Yeah, I did a few minutes ago, but yeah,
you see, I have two dogs. Your Star Wars joke yesterday.
I have two dogs, which are, I call them living room dogs. They spend most of the time indoors, and then they go out to the garden, they play, and every now and then, when they need to go out, they come up to me literally a foot away and just stare at me. I'm like, what do you want? Anyway, it's funny. Yeah, I love my dogs.
Yeah. Kay, do you want to have a little look around?
Can do, mate. I don't have an enormous lot to show today, but can do. Let's do the... If you
want to show some birds in your garden, feel free. We'll have a little bit of a nature show today.
All right. Yesterday we went in at the top end of this traffic zone in the differentials. Now we're coming off thanks to higher US yields. Well, your euro dollar is docile, a good follower of fashion, and we're a bit lower. So this thing is what we were talking about, and as long as we are here, I think it's going to, since it's all a yield story, it should keep euro dollar in ranges, and perhaps the crosses move a little bit. On what's happening in I could show the other yields as well, because as we were saying, like already actually a lot. If you look at the German yields have been coming down a little bit, and that's the differential then again where the US yields were pushing higher, but we are still at relatively lofty levels, right? So we have to pay attention to what our dear ECBers are saying as well. And I think somewhere that may keep crosses like euro yen a little bit better supported as well, as we are seeing. The yen is in pre-BOJ territory now, I think already. From at least, well, I know it's only next Friday, but March, the last month of the fiscal year as well, BOJ, last meeting of Kuroda, the change of the guard with USDJPY. And I think it's also one of the reasons why dollar yen is not really pushing through, but also doesn't get too much reasons to go much lower because of yields as we're pushing higher, and they are still at the end of the day in their YCC in Japan right now. So I think there could be a little bit of a stalemate in yen pairs, but the crosses may move around a little bit, and yeah, I think we had at least this one is a very decent level. It's a little lower now, around these high 142s, but we are hanging around the latest highs, and we can't ignore this, I think. So the market is had at least to reprice a bit, and for as long as now today we're trading above this 143.90 and then 144.40. Those are levels where I expect a little bit of support coming in, and we can overlay a lot of other yen pairs. They will all look pretty much similar because yields are moving in tandem. But this is one where I like to catch a little knife when it comes down, and perhaps retest. We're in sooner or later before the Bank of Japan. If they continue to talk the way they are, those Bank of Japan officials, I wouldn't rule out a test of this 146 at least, and then see what happens. But globally speaking, yeah, Ryan said like there's a possible double top forming here as well on the dollar yen. Perhaps this 137, because we also have this this confluence of the longer end MA's moving averages, the 100 and 200 confluence here. That's keeping a lead on the dollar yen for now, and the market is likely going to respect that until perhaps the BOJ. If ever it pushes through, decides to push through, if the US yields continue to push higher, the next level should be 137.60 at around 138.25, which is a prior high here. And also on the shorter end, it's where we had the last leg lower from. So 138.25, around there should see some resistance, in my opinion, ahead of the Bank of Japan meeting. Again, base case, nothing to expect from Kuroda, but he has surprised markets in the past. So is he going out with a bang? The small percentage is still there. It's not at all my base case, but since he has surprised people in the past, but to the dovish side, I doubt he's going to surprise us to the hawkish side. But if he would, then of course, I mean, this dollar yen is our yen is going to strengthen massively, and a move down to 130 or even to the prior lows is not excluded. But that's for the future. For the immediate, I'd say keep an eye on those levels, top side, and then the downside. As I was already saying, we are well above the cloud now. I think if we would go down anywhere to 134.75, 135.20 when around this zone, we should right now, barring dramatic news, find really decent support. We've actually tested it a little, stayed a little bit above, but we tested it yesterday, right? The low was around 135.20 or so, 25. That for the dollar yen. Metals, very, very undecided. Gold stopped into the resistance zone here. I said 42.48 yesterday. I said 42.48 is the resistance zone. Stopped right there, and we're back into to the support. I think as Stella already mentioned, higher yields across the board is not going to help to be of a great help to the metals right now. not excluded if this pushes through, these yields push through, that we are going to have a look back at those low 18s. If we start to push through above 42, 48 though in gold, there is a decent possibility that we are going there for another $30 higher. Silver, well, I think we can perfectly overlay that with the gold. Yesterday I said there was I was watching the close 2109, 2114. We just made it up to that prior low there, very close to that prior low, and rejected it again once the US yield started to rally, and here we are. We're back down below that zone. This is really on the close. This is going to be my first zone of interest on silver. If we start to close above, then I think there's a possibility that we are going back into the 22s. For the time being, just, I mean, however you want to play it, it's a bit of a zone of interest. Whether you want to short against it and then try to pick it up again in the mid 20s, up to you. And my very, very, very long-term position says I'm going to continue to build. I had just a little one here around 2070, and I'm very, very patient. Only above 22 figure 15 I'm going to really start to pay up, but for the time being, let nature do its thing. Euro dollar, I was saying, for me the big zone here is still going to be 104.6080. In the meantime, I think we play ping pong. You want to sell it against this zone that I highlighted yesterday, fine, but don't forget to take profits. 106 the figure, 105.80 yesterday's lows. Those are the levels that we watched to the downside. Bit of a turning around, neutral inside the last leg. But for the time being, with the US yields pushing higher, I doubt there is, unless data, because we are data dependent, unless data tell us that it's turning south in the United States, then I think we are just going to play ping pong for a while. Excuse me. What else? Yeah, we have to look at what's happening in China, of course. I highlighted this 684, 686 zone. We didn't reach it. I was actually having a bid in at 685, but didn't even get close. Now we're back into this other zone here, 690, 690, 692, 693, 694. I mean, those we've got 200 points here, I think, where we have to pay a little bit attention. Actually, the 694 perhaps not. I'm going to take that off. 690, 692 and a half. 93 is where dollar China should top out and go lower if it has to, or if it breaks back above, then a run to 7 is probably on the cards. Yeah, I know a lot of people have been trying to buy these dollar mix, but forces to admit that that thing has still not shown too much signs of turning a corner. And I think one still need solid butcher's gloves to catch knives in that pair. The zone is still, I think, 1850-52. If it breaks above there, then I think we have a chance of going back higher. But as long as we're below there, and keeping in mind that it's an 11.5% or so currency right now, it's tough to fight this, and we're finding it back as well in the euro mix. This looks like a bit of a intermediate little channel we were in, or I don't even know if technically we can call it a flag. Some people will tell me otherwise if I'm wrong, but we are through the previous lows in the 1930s. So the next one is likely going to be around the 1915 again. So for now, still no signs of a deeper pullback. I think risk really needs to fall out of bed before this particular euro and Mexican peso is going to turn a corner and see long Mexican positions start to unwind. Really, data has to turn sour, and especially in the US again. Well, really, this one we stopped bang on the 23.6 of the latest range, and coming back off, helped with higher oils, and gas is actually not going higher, but at least yeah, euro got capped, and euro Canada. I like to trade Americas as a bit of a block. So since the euro started to show bit signs of weakness, I took the fair bit of all my longs on this way up, and then got stopped on a trailer down below this little peak here overnight. I'm happy to watch it. Again, 144, 30, 40, the zone to watch on this Euro Canada. It's been a zone of interest in the past, and a bit of a crossroad between whether this pair trades lower or higher. So Shibuya crossing, here we are, and Shibuya is actually the busiest crossing in the world, if I'm not mistaken. For people having visited Tokyo, they will know what I'm talking about. So yeah, 144, 30, 40, that's again an area to watch. Anything else you people want to look at? Because I'm like, not really.
It's a bit quiet in the comments today. I think some people have gone to sleep.
Yeah. Aussie went for a retest yesterday of prior low 67.80. It was a fib that we identified before and really capped there, and we're back off. I think just a dollar play, and then perhaps the Chinese stuff where they hit a snag, as they said, is not helping the Aussie. I think it's a several rallies, this one still. I still think Aussie is a several rallies right now. Kiwi, similar, right? We went to retest this line here and this fib, and it stopped right there as well. So now we're back to, I think, 61.95, 62. The figure watching goes back below, then chance of seeing the prior lows if it holds. Prior chance to see this, and I think we're in a bit of a range, waiting for the next move. Aussie Kiwi, yeah, still hanging around there. This one here seems to have shown up those little springboards from where we went to see the latest highs. They are seemingly having something to say here. But really, the danger zone is still the low 107s, and top side, I reckon 108.50, 108.60, and then the 108.75, 85 will show up again. Thanks, Laura. Okay, Ryan, back to you, mate. I'm out of breath and out of IDs anyway today.
No worries, mate. Gavin, looking at Euro Kiwi, you're not pulling out the crosses, mate, didn't you?
You want me to have a look at it?
Yeah, you got stuff on there. I've not got a lot on there. It looks like we're in a bit of a channel.
You taking it, or shall I?
No, you go. You go.
All right, here, you can comment on it if you look at it. But it's, I think here, an interesting trend line coming up, Gav, around 169, 3/4, 169.80. That's going to be a level, and then this one, low 169s. Has to retake 171.5 to start going again, right? I don't know how you look at it, what you are watching. Weekly level around 171, weekly level around 171, weekly level. Hang on, because I haven't really put too much stuff on the weeklies. Weekly level around 71. This one, 170.87. I have it. Is it this one you're looking at, Gav? it's turning around, but I don't see really if it's of importance. If you look at the weekly moves, yeah,
I can see it on the 4 hourly, sort of
yeah.
171, 171.10. Bit of a short term.
This one, it's not there either, right? Okay. Anyway,
You stumped us. Kevin, you stumped us. You have to chuck a chart up in the chat room. We can have a look at that.
Yeah, do it in the chat room, mate. I mean, show it.
If you haven't already, of course.
Yeah. Yeah. This was the other spike. That was the month end galore on the Euro Kiwi, spiked above. Then we had into the fixing an absolute dump on the Euro crosses, and now we're back into this wedge. I think it's 171.5 really. All right. When long in US 30, hitting the 200 DMA may bounce back up. Is that on the futures that you went long, Anne? Or on yields?
Futures, yeah.
Futures. Okay. So you're playing a setback in yields. Yeah, I've seen a lot of people trying to pick. Yeah, okay. I've seen a lot of people trying to pick the top in yields, and you know what? I mean, I'm not going to say it's not right, because those levels are important. But and perhaps the longer term is going to be slower than the short term, but we have to respect those moves we are seeing. I'm feeling a bit uncomfortable, I must say, to try and pick the top in yields or the bottom in the futures. I know that technically in the futures it's a different affair, right? I mean, you can have a future price moving without really yields moving that much. But the issue is that you do a top, you come back, then you shoot through, then you stop around the level again, then you stop, one top, double top, bang, back down, one top, double top, back down, and then we're going again. And the issue I have with that is that it's one day we are going to really shoot, or possibly, you know. I mean, if you play it and it works well, fine. But if you play it on those multiple tries, make sure to have a stop in place, which is not going to cost you that much. I see I've got the 61.8 here at 403.60 on the 30s. So I don't know what that would represent in futures, but if it goes through here, I think it's bad news for the futures. But anyway, I mean, all right, I can see why you are doing it. All right. That's me really done talking.
Yeah, no worries. Good job as always, sir. Thank you very much. And thanks to Stel also for his valuable input. And dog advice, pet advice, always welcome on this show.
Yeah.
Thanks, chaps. Yeah, not a lot on the calendar today. Jobless claims, the pick of it. So just keep an eye on that in case there's any little wobbles for the jobs report next week. But we have a big day tomorrow, ISM and the like for services. Seeing if there's going to be any further divergence between manufacturing and services. We'll get all that tomorrow. So until then, please have a great day. Make lots of lovely pips. Trade safe, and we shall see you all tomorrow. Thank you very much.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.